All right, let's keep the convo going on the theme of the Morning Brief newsletter, disinflation versus inflation. Ryan Detrick is Chief Market Strategist at Carson Group. Ryan, always great to get some time with you, especially ahead of the big game. Do these markets need to fear, I would say, hawkish commentary from the likes of a Jamie Dimon?
No, we don't think they should fear him. I mean, that was a great conversation you guys just had. It was, 4 or 5 months ago, Jamie Dimon was talking about the economic hurricane that was coming, and we just made 500,000 jobs, so nobody is perfect. And I'll tell you, we continue to be in the camp that, yes, we agree at Carson Group, by the way. One more rate hike and then leave things there. We're not so sure they're going to cut rates. The economy's so strong. I mean, the economy's telling us that. So you can fear the Fed, you can do different things, but I'll tell you, inflation keeps coming down. Used car prices, rents, lots of 3 good core prints in a row, time to delivery. I can go on and on. The ECI last week, my goodness, that employment cost index. So sure, inflation's not perfect, but I'll tell you guys, we think it's more of a tailwind this year than clearly a headwind last year. And we pay attention to what Jamie Dimon's saying, but I'll tell you, just this morning, last comment, just this morning, his own economist at JP Morgan, guess what he said? Said the economy's pretty strong and inflation's coming back. So, lots of opinions out there, but, we still like the backdrop.
Ryan, what was in your coffee this morning? You're pretty fired up, my man.
I don't drink coffee. I just like coming on with you guys, and I'm excited about this.
Okay, fair enough.
Well, we appreciate that, Ryan, for sure. So if all of this scenario is correct, then that implies that the market is right. Like maybe we're not getting a cut this year, but the Fed is not going to be super aggressive, maybe not as much as the rhetoric would imply. So what does that mean? Does that mean, are stocks going to keep going up here? Are the lows in fact in?
Yeah, I think I answered your earlier question, guys. I've had a terrible cough. I've had a bunch of cough medicine. Maybe that's what's got me all fired up this morning. Get through this without a coughing attack.
Send me some.
Anyway, I've come on with you guys for a while saying just that. We think October was the lows. We had a 25% bear market. Your average non-recessionary bear market's 24%. And look what's happening now, right? Those high beta names are leading. What's not leading? Your defensives, your utilities, your healthcare. We saw that stuff 12 months ago. So again, the economy, in our opinion, we're going to avoid a recession. We've been in the soft landing camp the whole time. More people are kind of coming around to that, and that likely means stocks will do well. And just one final number on this: it is a midterm. Last year's a midterm year. Historically, they're not good. I've talked to you guys about that before. The average midterm year low, which last year was October 12th, a year later, the S&P is up 32% on average. Okay, that's just averages. We're up, 15, 16% off the lows. So could we be up 32% off the lows in October? Not our base case, but it's not as crazy as it sounds if you look back at history, especially if we can avoid a recession like we think we can.
Okay, and so that's somewhat of a deviation from what we're hearing from some CFOs at publicly traded companies, because they're basing in, or at least baking in right now for their base case, a mild recession. So why do you believe that there is that perhaps divergence or that range of deviation right now?
Yeah, it's a good point. I mean, I think there was a CEO survey yesterday, like over 90% of CEOs see a recession in the next 12 months. So again, we're not in that camp. I'm not a CEO, so maybe that's why I didn't get the vote in it. But I'll tell you this much. We still look at the consumer. The consumer is strong. Manufacturing, sure, in a recession. Housing, absolutely in a recession. We're seeing some better housing data. We're seeing mortgage rates going low. And that consumer, what Visa say, what MasterCard say, which is about every company saying, not every, but most companies are saying, hey, the consumer is still healthy. They make up 2/3 of the economy. Slow down, absolutely. But let's always remember this. The stock market leads the economy, and the strength we've seen, we think maybe means the second half of this year could be a lot better from an economic point of view than most people think.
All right, from the stock market to the gridiron, the NFL's big game is almost here, meaning strategists like you, Ryan, are watching the Super Bowl indicator. Let me guess, this is the perfect indicator for the stock market. If the Eagles win, the Dow's going to rip higher, right?
Well, I don't think there's such thing as anything perfect. I do got to say I'm a Bengals fan. I got to hold that up just for a second. Hopefully you see that. I'm a Bengals fan. I'm still reeling from our game, but let's get serious for a second, or maybe not. Full disclosure, this is fun. Historically, yes, stocks do a lot better when the NFC wins. S&P's up about 10% on average for the year versus 7% when the AFC wins. But something for everyone, for you Chiefs fans out there. Last 11 times an AFC team won the Super Bowl, the S&P was higher that year, 10 of them with some really strong returns. So this is, of course, playful, but historically, NFC is better for stocks. But it sure didn't work last year when my Bengals lost.
Okay, so you make it pretty clear in your note when you look at all these stats, and it's a lot of fun, right? The Super Bowl indicator It's just that. Like, it's fun. It's a fun way for us to talk about it. Like, what should we do with this stuff besides just come on and
bet on it?
Yeah, bet on it. Is that what you're going to do with this,
I can't say bet on anything, guys. I'm on TV right now. No, but yeah, I mean, it's just more fun than anything. Clearly, don't invest in this. But one more fun one. When I was looking at the data, so again, Bengals lost by 3 last year. Terrible year for the stock market. I said, is there something there? And sure enough, when there's a 3-touchdown win or more, so let's call it a blowout, S&P guys, again, don't invest in this, up 14% on average, higher 85% of the time. Single-digit wins. S&P's up like 5% for the year. So maybe we shouldn't root for the Chiefs or the Eagles. Maybe we should root for a blowout. One final thing, and I know, Brian, you tweeted this morning. When the Philadelphia team wins a championship, the Eagles have won 1. Stocks were down that year, but you look back, we've had great depressions when Philadelphia won the World Series. Panic of 1910, 1912, Philadelphia won the World Series. 2008, Philadelphia won the World Series. Hey, listen, I'm a fan of the city of brotherly love, but maybe stocks don't do as well when Philadelphia wins. So let's just think about that one. Don't yell at me, Eagles fans.
Oh, no.
Sorry.
We got one on set here, a big one. So
I know.
he might just yell at you right now.
Ryan, I'm gonna let it slide because you're approaching it from a quantitative and very numbers-based approach, and it's nothing about saying that one team is better than the other. It's really just looking at returns. So I'll give you that, Ryan. Look,
I did write a blog this week, and I said I think the Eagles are going to win. So I'm in the camp. The Eagles are going to win. So I think they got the better team. We'll see.
I appreciate that vote of confidence. Ryan, when we lastly think about the number of different outcomes that could take place as a result of, and even after this game aside, yeah, it's fun to really think about these Super Bowl indicators as well. But could this change how somebody might trade given we have Super Bowl indicators like this?
Well, I hope not. I hope no one truly invests in this stuff, I guess is my short answer. I would invest in this. Inflation's coming down. The Fed has one more hike. They're likely going to leave things, but the economy's still strong. And the cycles with all that internal strength, we're seeing more sectors, like 10 out of 11 sectors were recently above their 200-day moving average, right? That's internal strength. February's not a great month. Maybe we have a pullback in February. Perfectly normal. I hope that is what people take away from this conversation and everyone enjoys the big game.
Ryan, you didn't tell us who you're rooting for.
Well, like I said, I'll go with Eagles. I'm a scorned Bengal fan. I'm mad the Chiefs won. Congrats to the Chiefs. So I'm going to go with the Eagles. I'm indifferent, to be honest.
Did you have your Bengals thing to hold up again? I think we missed it the first time.
Oh, you did? Okay, yeah. So, okay, you missed it first. Okay, there's my Joe Burrow jersey. There you go. So he'll be back. We'll be back, you know,
right.
But, yeah.
Crush, well, as you should always say, of course, besides the Super Bowl indicator, stocks are driven by the present value of future cash flows. Right, Ryan? Yes, correct. Yes, absolutely.
Exactly.
All right, well, enjoy the big game, brother. Carson Group Chief Market Strategist Ryan Detrick, thank you for coming on, and thank you for the retweet.